So hi, everyone. Thanks again for joining us today, and thank you, Alex, for speaking. I know you've spoken in the past before, so it's always great to have you. So Alexander is the co-founder and managing director of Equivesto, which is a new Canadian equity crowdfunding platform that allows businesses to raise capital from the general public and get investment from their communities. Prior to founding Equivesto, Alexander worked for several years in both corporate banking and commercial banking at Scotiabank and has experience in the private equity space. Alexander also has a Bachelor's of Commerce degree from Smith School of Business at Queen's University. Thanks again for presenting today, Alexander, and good luck.
Thank you. Thanks, everyone, for joining me this afternoon. We're covering an introduction to equity crowdfunding. I'll probably talk for about 15-20 minutes, but if you have questions, please feel free to put them in the chat. So what is equity crowdfunding? There are actually three different types of crowdfunding, two of which you've probably heard about before through things like Kickstarter and GoFundMe. So the first type of crowdfunding is donation-based crowdfunding. And so this is really where GoFundMe fits. So people provide funds to a person or a business or a cause for nothing, just as a donation. The second type of crowdfunding is rewards-based crowdfunding. So this is kind of Kickstarter. This is where people are offering funds in exchange for the pre-purchase of a product or an item that they will get, in a few years after it is actually fully developed. The third type of crowdfunding is, of course, equity crowdfunding. Alex, are you? I saw you just joined back then. You're still there? Okay, perfect. Hi, everyone. Welcome back again. So the third type is equity crowdfunding. And essentially, equity crowdfunding is where you're able to take funds from the general public, but you're actually offering a piece of ownership of the company in exchange. So how exactly does equity crowdfunding work? So equity crowdfunding, which involves a platform in the middle, essentially uses that platform as a middle point. So the investors bring the capital in small micro amounts that they plan on investing in the company. The platform helps gather that all together and then provides that to the company, and the company offers to the investor some ownership. What does that ownership look like? That ownership can come in the form of shares, specifically pieces of ownership of the business. Companies can choose the types of shares that they issue to the general public. So there could be common shares or preferred shares, other types of shares. They can get quite detailed, but typically what's often issued are non-voting common shares. This allows the investors to participate, get a piece of ownership in the business and share, in its potential success, but it also keeps the control of the business in the hands of the founders. Where does equity crowdfunding sort of fit in the cycle of businesses raising money, the capital life cycle? So typically when you fund and found your business initially, you're just at the idea stage. This is where you're looking for funds from friends and family. You'll raise around $100,000 to really flesh out the concept and get started. After that, once you have an MVP or a prototype, but potentially before you've started generating any revenue, this is where equity crowdfunding fits, which is the seed round. This is also usually where angel investors would also participate in investing in the business. So through equity crowdfunding, you can raise between $25,000 and $1.5 million for your business. And this is usually right at the point where you have your MVP and you're looking to really scale that, take it to market, generate some sales, and expand your marketing. After raising successfully from angel investors or equity crowdfunding, then for your Series A, you typically go for funds from venture capital or other institutional investors before potentially going public in several years' time. So before I dive into equity crowdfunding in Canada, let's talk about equity crowdfunding internationally. Canada has been a bit slow in getting equity crowdfunding rules approved and really functional, but in the US and the UK, equity crowdfunding became legal and became accessible for investors several years prior to Canada. As such, we're able to look at the US and the UK markets as a bit of a sort of example for the future. So in both the US and the UK, there are several successful platforms that have really made a difference in the market. And in both countries, companies have raised over $1 billion for startups. So they've really become quite successful, and it's really grown. So we can see that, in similar circumstances, there's potential for that to happen in Canada as well. So let's talk about Canada specifically and some of the rules relating to equity crowdfunding. So there's a lot of information on the slide. Don't bother reading it. I'll just outline it all for you. But essentially, whenever you're issuing ownership, you're issuing securities in your business, that is regulated by the Canadian securities regulators. Before, with the other types of crowdfunding, like rewards-based or donation-based, because you're not necessarily promising anything to the individuals, they're not getting any ownership in the business in those other scenarios, that's not controlled by securities regulators. But because you are issuing ownership of the business, that is quite regulated. And every country regulates that differently based on their own sets of rules and expectations. So in the US, that entire industry is regulated by the SEC, the Security and Exchange Commission. There's one regulator for the whole country, makes it a bit easier. In Canada, there's a different regulator for securities for every single province. So there's the Ontario Securities Commission for Ontario, there's one for Alberta, BC, Nova Scotia, on and on. And so initially, when crowdfunding rolled out in Canada, not all of them agreed, and the rules sort of all didn't coordinate. Equity crowdfunding, in the general term that we applied to describe that idea of, the crowd pooling together to buy a small piece of a business, that is actually split up into several different sets of rules created by the regulators. But finally, cutting to the chase, a new set of rules has finally been agreed by all of the 8 major provinces. That has one unified set of rules, which I'll talk about in a minute. So now it's as if there's one regulator for the whole country. So that's really fantastic. That set of rules is called Prospectus Exemption 45-110. The Startup Crowdfunding Exemption. And that actually comes into effect September 21st, 2021 this year. So that makes it a lot easier for any companies looking to raise funds via equity crowdfunding, because now there's one set of rules, you can use it across Canada, and everyone sort of knows what's going on there. So those set of rules make it very clear who can raise via equity crowdfunding, where they can do it, and who can invest in companies. There are 2 different types of platforms that can allow and support equity crowdfunding. Companies cannot equity crowdfund on their own. They have to work with a platform that's been reviewed and approved by the securities regulators. There are 2 different types of platforms that you could work with. One is called an exempt funding portal. This is essentially just a listing location and doesn't have much ability to issue securities or help companies raise capital beyond specifically using the equity crowdfunding rules. Also, this portal isn't allowed to give investment advice to anyone signing up to invest through the portal. There's simply a location where companies sort of put their information and then investors can choose to participate. As such, investors who go through one of these portals are limited to a maximum investment per campaign of $1,500. The other type of platform, the ones that are being used most frequently, and which Equivesto, my company, is one of these, is a registered funding portal that's operated by something called an exempt market dealer. Essentially, an exempt market dealer is a fully licensed securities dealer that's fully regulated by all the different securities commissions and has to meet a whole laundry list of rules in order to protect both the companies raising capital and the investors. Exempt market dealers can use many different types of rules to help companies raise capital, but in this situation, they can also use the equity crowdfunding rules through a portal to allow investors to participate in equity crowdfunding deals. Because exempt market dealers have all these additional responsibilities, they sort of can act like a financial advisor and provide financial advice to investors about the investments on the platform. Because they're providing that advice, we're able to have higher investment limits for individuals who want to participate if, based on that advice and understanding of the situation, we deem that it's suitable. So through an EMD, an exempt market dealer run portal, investors can participate up to $10,000 per campaign instead of the 1,500. Companies with both of them can raise up to 1.5 million though. EMDs have many other requirements that they have to meet, including annual audited financial statements as well. And so there is a lot more scrutiny that goes into reviewing those EMDs by the securities regulators. So now that you sort of understand what are the two types of platforms that can be run, who can actually participate and who can invest. So there are two types of investors that I've highlighted here who can participate in equity crowdfunding. The first are retail investors. So this is basically everyone who's over 18 years of age, and retail investors are limited by securities rules to that 1,500 if they don't get any advice and review from an exempt market dealer. However, if they do get further advice and feedback, and the EMD is able to determine that they're suitable for investing larger amounts, they're able to invest all the way up to $10,000. But typically on my platform, Equivesto, investors are given limits of $2,500 per campaign. There's also a maximum investment limit per year, but that's going away as part of those new rules coming out next month. There's also accredited investors. So these are high net worth individuals, but they have to demonstrate their net worth in order to get access to no investment limits. So when someone is signing up, they have to fill out some, information about themselves, their income, their assets, as part of the sort of financial review and determination of their limits. Through that process, if it's clear that they potentially could be an accredited investor, they're given the choice to either provide further documentation like an investment account or a tax return to demonstrate that they are an accredited investor and have a higher net worth to gain access to those limits, or they can forego that along with everyone else and have lower limits as a retail investor. But there are two different types who can participate depending on the net worth. So who as an investor can't participate? So this is important to keep in mind with equity crowdfunding. Unlike other types of crowdfunding, where the funds are basically going to the company from the individual with no real promise of anything in return, with equity crowdfunding, because you're actually purchasing a piece of ownership of the company, you do have to follow those securities laws. And so what does that mean in this situation? As a company raising capital, you are, and the investors who are participating in your raise, they are governed by the securities laws where the investor lives. So even if you have a company in Ontario, if you're taking an investor from Quebec or BC, you have to make sure that they're allowed to participate based on the securities laws in Quebec and BC. It doesn't actually matter that you're in Ontario. The same thing applies internationally. If you're taking funds from a US investor, you actually have to check and make sure that that individual is allowed to participate and invest in you according to American securities laws or German securities laws or wherever. So it can be a bit challenging. Because of the rules being based on where the investor lives, there are 5 provinces and territories, Newfoundland, the Yukon, Northwest Territories, Nunavut, and Prince Edward Island, that all actually do not allow equity crowdfunding. So what that means is, even though the other 8 provinces all agreed and there's this new set of rules, these 5 provinces and territories, you can't take investors who live in those provinces at this moment in time. The same thing, if you're running an equity crowdfunding campaign on a Canadian platform, the Canadian platform, because it's not licensed in the United States, can't take US investors into your business through the crowdfunding round. If you wanted to take American investors through an equity crowdfunding round, you'd actually need to run a second equity crowdfunding round in the United States at the same time. So you'd need a Canadian one for Canadian investors, and then you would need an American one for American investors, which can be a little bit challenging. Let's talk about the companies who can equity crowdfund and what's required. So in order to equity crowdfund in Canada, you need to be operating in Canada you need to be registered as either a corporation or a partnership or a co-op. You can raise up to a maximum of $1.5 million Canadian in a rolling 12-month period. You do not require financial statements, but you do require to have a minimum viable product or service, or at least a demo version. If you're beyond that and you're already operating, that's fantastic. But if you are purely in the idea stage, so you've got a sort of pitch deck or something to sort of describe what you want, but if it's a piece of technology, you haven't built it out, or if it's a store that you want to buy or a store you want to operate, you don't have, a drafted lease agreement and you don't know who you're going to hire and all that sort of stuff, then you wouldn't be eligible. But you do not need to have revenue. So you can be a pre-revenue company and still raise funds through equity crowdfunding. What are the ongoing requirements of equity crowdfunding? There are no specific additional ongoing reporting requirements related to equity crowdfunding. All companies who have more than one shareholder need to have an annual shareholders meeting. That is still a remaining requirement, but there's no additional sort of reporting. You don't need to provide financial statements to the regulators. You do need to provide annual financial statements to your shareholders, but again, that's an existing requirement, not a new requirement. What type of companies cannot participate in equity crowdfunding? Obviously, public companies that are already listed on the stock market, they cannot participate in equity crowdfunding, makes sense. And passive investment companies, so passive real estate investment funds and passive investment funds like a mutual fund can't participate in these specific equity crowdfunding rules. Why is that, you might ask? There are already existing rules that the regulators have created to allow these types of investment funds to raise capital, because these have specific needs related to running a private investment fund or a real estate fund. The government has additional requirements on those funds to keep investors safe. So the existing rules govern how both passive real estate investment funds or passive investment funds can raise money. And so as such, they're not able to use these sort of simplified equity crowdfunding rules available to other companies. So, okay, we know who can participate, we know generally how it works, and we know what businesses actually need, what stage they need to be at to use equity crowdfunding. What businesses actually work best with equity crowdfunding? So as I'm sure you can surmise, startups work typically well with equity crowdfunding, especially ones with an exciting new idea that captures the imagination and is creating a strong positive impact locally or globally. So with equity crowdfunding, if your business is something that's doing something innovative and really making a difference to a lot of people and it's well understood by the general public, that's a great fit. Also, small businesses work well with equity crowdfunding, specifically ones with a strong community focus and positive impact locally, like a restaurant, a favorite store, a winery, a brewery. These type of businesses, because they have active and excited communities who frequently purchase their product or visit them, they're going to have a group of people who would be interested in coming in and investing in them. For both startups and small businesses, the key here is really to be understandable to the general public and to have a community around you, or to be in the process of building a community around you of people who would be interested in participating and investing in you. Even though platforms have thousands of investors on them, there's no guarantee that those investors would choose to participate in your business. So a critical piece of success for equity crowdfunding is that companies have taken the time to grow their organic extended community and have a really strong marketing plan to make sure that they know how to sort of go out and turn that extended community into potential investors. If you wanted to work with Equivesto, we have some really great marketing firms that we can connect you with who have a lot of experience in this area. But what businesses don't work very well with equity crowdfunding? Typically, businesses where the value of the business itself is actually tied specifically to a small number of employees. So if you have a startup and you're building some technology, yes, your employees are creating that value, but it's going into this piece of technology that the company owns. However, if your company is just a consulting company, so Other companies hire you to give them advice, but that advice comes from your small group of employees. There's not a lot of value in the business itself. So that type of business doesn't work well with equity crowdfunding. Also, highly technical business-to-business companies can also be a challenge, because a key piece of equity crowdfunding is building that community, building that network, and then convincing them to come in and participate and invest in you. So even if your business idea is very good and could potentially make a lot of money, if it's not something that can be easily explained and captivating to a wider audience, you may not have success with your campaign. So what types of documents are needed to go in equity crowdfund? What do you need to prepare? Well, you need a certificate of incorporation, a capitalization table, an organizational chart, business plan, pitch deck, financial statements if you have them, but that's not mandatory, shareholders agreement, some financial projections, and you need to know how much money you want to raise and why. What are you going to use it for? There's one other document that's very important, but this document you will work with the platform to help create, as well as your lawyers. This document is called the offering document. Essentially, it's a very expanded term sheet that's required by the securities regulators as part of your equity crowdfunding round. This document has a full summary of everything that an investor would need to know, and it puts it forward to them in a sort of clear and concise way. This document is signed off by the company and filed with the regulators at the end of the campaign. So it's very important to make sure that the government and you have sort of reviewed and perfected the document, because you are going to be giving it to the regulators at the end. But if you work with Equivesto, we help you to make sure that the document is all set up properly. So that's kind of a rundown of everything you need to know about equity crowdfunding in Canada, what it is, how it works, and how you can participate. If you want to learn more, my company, Equivesto, has a really extensive learning center, both from the investor perspective and the company perspective. That's at equivesto.com/learn. You can also shoot me an email directly, alexander.morsink@equivesto.com, or you can follow us on Instagram or other social media channels at Equivesto. If you have any questions, I will look for them now in the chat, and thank you for joining us. All right. Not seeing any questions yet. If you have any questions, feel free to throw them in the chat. Let's go back. All right. I don't think there are any questions, so I'm going to end the session here. But thank you very much, everyone, for joining us. Feel free to reach out or follow us on social media if you do have any questions. And I hope you enjoy the rest of your day and the rest of the conference. Thank you.